Good evening and a warm welcome, ladies and gentlemen, dear members of RDCL, dear partners, dear colleagues, dear friends of the Konrad Adenauer Foundation. My name is Michael Bauer. I'm the head of the Lebanon office of Konrad Adenauer Foundation. It's a great pleasure for me to welcome you to today's paper launch and I would say food for thought workshop on addressing the Lebanese banking crisis. Is a good bank, bad bank, restructuring the solution? Of course, I would like specifically and particularly to thank Adel Afiuni, who agreed to present the concept of good bank, bad bank here today at this workshop. And I would like to also thank Jean Taville, who will be facilitating and moderating the whole event, and who also wrote a paper on the good bank, bad bank methodology, which you received together with the invitation to this event, and you can access it also on our website. And Jean will also, of course, entertain questions later on today. And I would like to also thank Nicolas Buchata and RDCL to join us for this launching event. We've had a couple of events now over the past months and studies, and I'm very glad that we add this event today to our list of joint endeavors, and I do look forward also, of course, to future projects with RDCL and with you, Nicola. We as Konrad Adenauer Foundation, we try to facilitate debate and discussion and dialogue on all facets of the political life in our international work. Together with partners, we develop proposals and ideas on various political topics that we think are relevant, and we seek to provide a platform and a forum to discuss and evaluate policy proposals. And this is what we are going to do today with the concept of bad bank, good bank, bad bank as a possible way to deal with the crisis in the banking sector here in Lebanon. If you look at the discussions and the reports on the negotiations with the IMF as a foreign observer, then you often get the impression it's more about smoke and mirrors and symbolic gestures than substantial political debates. And what the IMF has repeatedly criticized is missing are concrete reform proposals to put on the table, be it on how to deal with state-owned enterprises, fiscal policy, on the forensic audit of the central bank's accounts, and last but not least, a very central point, of course, is the restructuring of the financial sector and of the banking sector. And so I'm very glad that today we'll have the chance to hear a very concrete proposal and discuss it together, of course, also with our audience here today, on how to deal with the crisis in the banking sector, which is, of course, a very central sector for any economy, as you have to have a functioning banking sector, financial sector, in order to finance economic activities and investments. So I very much look forward to this discussion. I will stop here, and I wish everyone, all of us, and hopefully insightful and interesting discussion and helpful findings. Thank you.
Michael, thank you very much, first of all, for promoting and supporting the private sector on these important topics. On behalf of RDCL, thank you for CAS, and welcome to our speakers, Mr. Afiuni and Mr. Tawili, on this important topic, good banks and bad banks. We all agree that the situation is extremely complicated, politically, socially, economically, financially. The private legal sector size is unfortunately shrinking, all to the benefits of an illegal parallel economy sector, which proliferates in the current environment. Moreover, the state have failed to manage properly state-owned assets and institutions for decades, as long as clientelism, corruption, and bad management were an issue. Making access to basic proper infrastructure, competitive infrastructure, affordable infrastructure, very limited, not to say completely absent, unfortunately. Without the return of trust as well in the banking sector and properly managed state-owned assets and institutions, so both of them, we won't be able to ignite again the GDP growth, and the descent into abyss is unfortunately the only way forward if this does not happen. Therefore, a complete and comprehensive methodology that we'll talk today about, the bad bank, good bank approach, that addresses both issues would probably be key to kickstart our nation on solid grounds. This time on a competitive model, which would promote the private sector, the PPP, from one side, and which would give value to these currently badly managed assets, state-owned assets. So I won't be long. I will give the floor to Jean Tawile, which will take you from there, and we'll be happy to take questions at the end of the presentation. Thank you.
Thank you, Michael. Thank you, Nicolas. And from my side, with no further delay, because we've seen how much the delay and how much time is of essence during a crisis, and how much delaying solving the issues, how much it's costing us and costing the private sector and costing our kids and our future a huge cost, all this. So I'm really happy to introduce Mr. Adel Afyouni. Adel Afyouni, a senior banker, former Minister of State. Adel was who proposed and advocated from the very first beginning of this crisis the good bank, bad bank methodology. And if the supposed people who are supposed to be managing the country during its worst economic crisis and one of the worst crises in the history would have spared us a lot if this methodology was applied from the very first beginning. So I'm really happy now to give the floor to Mr. Adel Afyouni. First of all, at the end of Adel's intervention, please, for those who have any question, for those who would like to do an intervention, just on the Q&A part, send us a message. Either you can ask a question or just ask us to give you the floor, and we'd be more than happy for the people to ask questions and to have a really interactive discussion with Adel, with Michael, with Nicolas, and with myself. Thank you so much for attending and for listening. And Adel, the floor is yours.
Hi, good afternoon, everyone. And thank you for inviting me. Thank you to Konrad Adenauer. Thank you to RDCL. By the way, I'm on video, but I can't, for some reason, I'm unable to put the video on. I don't know if this is on purpose or a technical glitch, but I'm trying to take the video off. It says I'm not able to do so.
Adel, I'll check from my side, 1 second, but go ahead, please.
Okay. Anyway, thank you everyone for inviting me. And again, I'm very happy to be here today. As you said, all of you actually, the banking crisis is one of the most painful crises that I've seen in my lifetime in similar emerging markets, and obviously very painful at every level in our country. Painful for the depositors, painful for the economy, because there's no economy and there's no possible growth. And you, of all people, know this without a proper functioning banking sector. And painful also for all the people who work in banks, which has been one of our pillar sectors in the economy and a pride for the country. So everything we're doing here is in the context of we need to save the banking sector, putting it back on its feet because it's needed for all the reasons I mentioned above. Unfortunately, as you mentioned, Jean, for the last 2 years or 2 years and a half now, since the beginning of the crisis, I believe we've done the opposite of what should have been done. And this has obviously aggravated the crisis. And really, the biggest cost has been on the population, whether it's the economy and entrepreneurs or depositors who have seen their life savings bleeding progressively because of the lack of action that we've witnessed.
Adil, sorry, can you try and turn on the camera now?
Sure.
Great. You
Okay.
look great.
Can you see me now? Just to make sure that you know that I'm here. Sorry, I'm just positioning the video properly. Here you go. Okay. All right. Let me get back to what I was saying. So basically, you know, the reality is, again, can you hear me well, by the way?
Yes.
With the video on? Okay. So what I suggested 2 years ago or 2.5 years ago as a methodology, and I keep talking about it, even though the more we delay the implementation, the more difficult it becomes, as we all know. But it's still, in my opinion, a methodology that is very valid, even more so now, because we're running out of options. So what is the basic principle behind this? Let me take a quick step back. What is a bank ultimately? A bank is a really very privileged license. You give a group of shareholders and investors the right to take deposits from retail investors or from the retail or from the citizens. And that's a pretty big privilege. And in return for
I think we are having a technical problem from Adil's side.
taking money from the people on the street, but on the other hand, you are being required to play a role in financing the economy, and you are being required to abide by key rules of diversification, liquidity, and capital adequacy. And we've had for a very long number of years, a very well-performing banking sector, which played a key role in financing the economy, and was always mentioned as an example of solid management and rating. Now, over the last years or even decades, this has drifted. This has drifted in a way that basically led to the crisis, in my opinion. Why? Because banks moved from their initial mission of financing the economy, financing entrepreneurs, financing consumers, and said to themselves in Lebanon, why do I need to do all that? It's too complicated. I make more money, and it's much simpler to finance the government, buy Eurobonds, or even put my money at the central bank where I earn very attractive rates. And it's pretty straightforward. As my central bank, I don't need to do much work. So those banks started shifting progressively from what was their initial mission and what is the role of a commercial bank into becoming an investment bank, i.e. investing in risky assets. And even more so, actually, there was no diversification. It's not like, they decided we're going to only invest in, a diversified portfolio. No, it was only like sovereign credit and BDL credit was a much simpler business. And obviously the regulators, who were very happy with that because they are the beneficiaries of this kind of operation, closed their eyes or allowed them and incentivized them to do more of that. What is the result before the crisis is we ended up with two banking entities effectively in each bank, or two entities. One is the normal commercial banking activity, the core of banking mission, and that counted probably at the end for 30 to 40% max of those banks. And the other entity was actually an investment portfolio dedicated to investing in CDs of the central bank, financial engineering transaction, or sovereign credit risk. So a fixed income portfolio effectively with one single credit. And this is, in my opinion, the original sin. No matter what the pressure is, no matter what the context is, ultimately, they transform the bank from a commercial bank into increasingly a fixed income portfolio. And the idea behind the good bank, bad bank solution is to go back to basic, reverse this basically original sin. Go back to what banks are supposed to do and are needed for, which is commercial banking. And that portfolio of fixed income, which is the problem, still until today, they don't agree how to value it. They don't agree if there is a default from the government or not. And what's the haircut. They can't agree on how to treat the CDs at the central bank and whether the central bank is bankrupt or not. I mean, all this debate is really about the fixed income portfolio, which again, is, as I said, should not have been in the banks from the start. So the good bank, bad bank solution is precisely this. Let's go back to basics. Take out this fixed income portfolio, which is the problem, the cancer basically, and put it in a separate company so we can deal with it separately. And let's keep the commercial banking portfolio, which is the core banking system and which is much needed in the bank, and try to deal with this on the other hand, because this is much simpler to deal with, and this will salvage the banking sector, the people working in the banking sector, and the customers of the banking sectors, i.e. the economy, because it will allow them to recapitalize and and get on with financing the economy. The bad banks, this fixed income portfolio, obviously will take much longer to deal with, and it's much more complicated. But why keep it? It's like when someone has basically, when the body is sick and you have basically an arm on a leg that is affecting everything else, you cut it, right? This is the idea. Just take this out of the bank, let the bank get on with the normal business and recapitalize and restructure and get back its role, obviously much smaller by definition, because that's the size of the economy anyway. And that monster fixed income portfolio, which now is in default and where we're struggling to value it, to deal with it, take it and put it in a private company. So really the idea is to simplify the solution by splitting into two and solve everyone separately. And by the way, this is nothing new. We've seen it from, in every single financial crisis, banks, sometimes individual banks or sectors doing the split. By the way, the first to do it was the US after the 1928 crisis, where they basically implemented the Glass-Steagall Act. At the time, they banned actually commercial banks who take deposits from doing investment banking activity that is risky. They told banks, if you're taking citizens' deposits, you cannot take risk with investment portfolio. If you want to take risk with investment portfolio, you do it off balance sheet in a separate entity where you're not risking your depositors' money. This is what should have happened with our regulators, and this is what should have happened with the risk committees and the management. They should have put that fixed income portfolio separately, run it on behalf of investors or depositors who are willing to take the risk, rather than basically mix it with the citizens' deposits and the savers and the pensioners and the pension funds deposits, and basically take the risk with everything. So that's my starting point. Go back to basics, spin off or split those two activities, keep the commercial banking activity inside the bank, and move the investment portfolio activity into a separate company. Now, obviously, this is easier said than done because it's very complicated and has to be done at every bank's level. So how do we do it, or how I propose to do it? Once we split the assets, we obviously need to think about how do we split the liabilities. That's the biggest and most complicated things. And by liability, I mean deposits first and then shareholders. So once I've split those two assets, one is on one hand, as I said, I have a commercial banking activity, that's the future banking sector. On the other hand, I have a private company that is holding all the fixed income portfolio, which is the troubled assets. What do I do with the liabilities? I have deposits who basically are in the bank. They didn't decide what they're funding their liabilities for the entire bank. It's a very complicated, basically discussion. I have to admit it. And I'm not saying it's easy to implement, but we have to find a way to split those deposits between the good bank, i.e. the commercial portfolio, the normal bank, and the investment portfolio, which has now become a private company, which we call the bad bank. How do we split the deposit? This has to be a big debate. It depends first and foremost on the capacity. Like, you cannot put all the deposits in the good bank because the good banks by definition is very small. It doesn't require that much deposits. So we need to, through the methodology, in my proposal, which is an article that I published 2 years ago, and then I refreshed it several times to kind of remind people of this methodology, I think the most straightforward is to put the small deposits up to a certain level back into the commercial bank, because those small deposits belong to a commercial bank, i.e. a diversified, low type of risk entity. And if we restructure its balance sheet, we now have the small deposits there. We recapitalize it. So we raise money for an entity which basically has a portfolio that we've restructured of commercial lending and consumer lending and corporate lending, diversified. Then those small depositors are back into a proper retail and commercial bank with diversification, with good capitalization, and where we can also add even a deposit insurance scheme to protect it. Again, this is the theory. I don't claim that this is easy to be done, but that's the principle. We move that commercial, we spin off, as I said, the fixed income portfolio. We have now a commercial loan bank with all assets, which are basically commercial lending assets. We recapitalize, we restructure the balance sheet, we raise capital, and we put deposits as much as we can from the small deposits. Then we go to the rest of the deposits. Those are left by definition into the bad bank, okay? So basically they're there owning a portfolio of fixed income securities. Now, another methodology could be to do it simply pro rata. In order not to have to split, we can say, okay, we just do it pro rata. So always every depositor, whether he's big or small, has a percentage in the good bank and a percentage in the bad bank. I don't have a view on that. It really depends on the structure of whatever is left of the deposits and how we want to operate that. But let's assume that the big depositors, we move them into the bad bank. So now they own a portfolio of fixed income securities, which is everything that the banks used to own. But this is now a private company, a special purpose company, owned by the depositors that owns all the assets of the banks that are invested in CDs at the central bank, deposit at the central bank, and Eurobonds or debt from the state. Again, the devil is in the details. I'm just trying to give an overview of an overview of how it could work, but one can drill into those details. I prefer not to go into them at this stage because this is subject to what is left in the banks and looking at their portfolio in more details and their depositors. But let's assume a portion of those depositors is now owning the bad bank. That is now the biggest creditor to the state. So all of a sudden, we've made those depositors more senior than when they were in the bank, because now they're facing the state directly. They're not facing the banks who are facing the state. There's no more intermediation between them and the bank. They own a company which owns all those debt issued by the state, and they will be able to negotiate directly with the state how to restructure this debt. And I think this is better than for them being stuck in banks which actually have stopped, don't own anything left else but the fixed income portfolio. So with that, now this private company is going to negotiate directly with the state on debt restructuring, on how to compensate for the losses on deposits, how to reclaim as much as possible from the debt instrument that they own, and what kind of incentives they should get from the state in order to reduce the losses of those deposits. That's how we treat the deposits, okay? Quickly as well, like trying to go further, what happens to the shareholders? So once we've done this, we've split the liabilities of the depositors, the shareholders come next. We're not gonna ignore them. We're just gonna apply basic rules of capitalism, which is basically that the shareholders are junior to the depositors, and we're gonna try to protect their rights as much as possible. So we're gonna split their equity pro rata as well between the good bank and the bad bank. In the good bank, they're gonna have to absorb, like any shareholder in any company, all the losses of the good bank, because there are obviously losses in the good bank. If anything is left for them, if their equity is still there after they absorb all the losses, they still own a small percentage of this good bank. And then we're gonna raise capital, as I said, for the good bank. And they have every right to participate by recapitalizing the good bank if they want to stay as shareholders. If not, they've been wiped out, again, like in any capitalistic structure, because they had to absorb the losses of the commercial banking portfolio. Their share in the bad bank, again, they're still owner of that portfolio, so there will be shareholders in that company, but they have to, again, by definition, by construct, to be junior to the depositors. as again is the basic rule of capitalism. They have to be junior to the depositors. Therefore, whatever income they will get from that position will have to come after the depositors have been paid from the bad bank. As we know, it's impossible to pretend that the depositor will be fully paid from the bad bank because the government will have to restructure or haircut its debt. They have no capacity to repay everything by definition. Therefore, it's very unlikely that the shareholders will be able to retain any revenue from that position. But it is what it is. As I keep saying, this is the basic rule. If their shareholders, depositors come first, and whatever is left from the restructuring of the government debt and the central bank debt, they can get it if there is anything left. So this is, in a nutshell, how I summarize it. Why is this, in my opinion, a good methodology? One, it doesn't prevent any other solution that is being proposed. I'm personally against the use of state assets, but even if we were to use state assets, this doesn't prevent it. We can use state assets. We can use any restructuring solution. We're simply splitting the problem into two to make it simpler, to make it easier to manage, and to have an up and running banking sector as fast as possible through the good bank. Not to have to wait for debt restructuring of the bad bank in order to kickstart the banking sector again. So it is a methodology. It's not a hard-coded solution. This methodology is flexible. Two, as I said, it's better for the banking sector. You'll have a functioning banking sector through the good bank while you wait to renegotiate and agree a solution on the debt of the bad bank and start seeing income or revenue coming from that. Three, it's good for depositors because those depositors in the good bank are back to a proper banking sector, which has been recapitalized. And those depositors in the bad bank, they're not back in the good banking sector, but at least they're more senior in the waterfall. They're now directly a creditor to the state. They can negotiate directly how much they can generate from the state, and they can actually put the state on the spot because, as we all know, ultimately the state is responsible for this massive crisis through mismanagement, corruption, and bad financial policies. So this puts the owners of the bad bank, i.e. the depositors, directly at the pari passu level with all other creditors of the state, be it Eurobond holders or other creditors. And I think that's better for those depositors than to have deposits in the bank and have the bank as an intermediary between them and the state. It's also better for shareholders, in my opinion, because it simplifies the problem. They can stay in the good bank, but if they can't absorb the losses, then that's basically because they've mismanaged their portfolio of commercial loans and it went badly. But at least it protects their right in the good bank. And in the bad bank, again, it protects their rights, but they have to be junior to all their depositors by definition because they're equity holders. So in my opinion, it's most natural and scientific solution as I just described it. I have to caveat that, obviously. The devil is in the details. It's a very complicated crisis. Can't describe it in 20 minutes, nor do I have actually the numbers or any one of us to really go into the nitty-gritty. That's why I keep saying it's a methodology that simplifies how we solve it, but it's not a ready-made solution yet. Now, this is important to keep in mind. It's also important to keep in mind that this requires a whole condition precedent to be implemented, which is the same for any other solution, i.e. a transparent governance. Someone has to be in charge of this whole process, has to be authorities that are trusted, credible, independent, and transparent. Easier said than done. I know it's in the current context, not the case or not easy to identify, but any solution for that matter that we would implement would require the same type of governance and the same type of independent entities that would oversee the full process, whether it's, again, the splitting of deposits, the management of the bad bank, the negotiation on the debt restructuring. All this would require, obviously, a new regulatory framework, new regulatory authorities, and a new management and branding for the good banks. Because I think this is very important the good bank or the good banking sector will need to be rebranded with fresh management, which is credible and which basically can attract confidence and trust. The last point I want to add is financial markets and financial instruments give us a lot of tools to improve the situation in the good bank and the bad bank. So we're not only saying, okay, the bad bank, let those depositors own this portfolio of troubled assets and let's see how much they can recover from the state. I've always believed that we need to actually hold the state accountable. We want to hold the state accountable for their mismanagement because they are at the origin of the crisis. We cannot deny it, okay? Or we cannot ignore it. So how do we do that? In my opinion, we should, one, split depositors. We need, even in the bad bank, there are some depositors who were purely saving money and others which basically were speculating because either they're foreigners who send their money just to speculate, seeking high yield, or to basically earn high interest rate, even though they live abroad and they have no reason to have money in local Lebanese banks, except taking the risk in order to earn the returns. So you have different type of depositors. We need to do almost a forensic audit of these depositors. Which ones are clean deposits, which are not, which one are savings for like pensions, for people who just like retired or actually lived in the country and put their money at the bank, at the branch next door, and which ones were really like speculating and taking risks. Very complicated, but I think it's only fair because the bill or the liabilities that we want the state to carry should be only directed at those who basically deserve that state support. Because remember, state is taxpayers' money. So state is accountable to its citizens, to those who lost their life saving, because that's a major social problem because of the state's bad management. But state is not accountable to a foreign investor who came knowing that Lebanon is a single B minus and that it is in a bad situation, came to earn some high interest through a deposit, and now he wants the state to compensate it. So we need to reduce that bill on the state. That's one principle, in my opinion, which is important. Then once we've reduced this bill on the state and focus only on the well-deserving, I mean, quote unquote, because that's a very like vague term, depositors, we need the state to try to compensate them by issuing financial instruments such as contingent liabilities. So using the state to issue additional incentives to compensate depositors is not unheard of, but those instruments have to be contingent liabilities, i.e. they have to depend, or their return or their income has to depend on how well the state is doing financially, whether it privatizes assets and generates revenue. We can give a percentage of that. We can issue convertible bonds. We can issue GDP warrants. So if the GDP is better, the state's paying more. We can issue oil or gas warrants. So if we discover oil, the state can give some part of that as incentives to those depositors. And again, all this is under the principle of one, making sure that the financial, public finance are well managed. Two, that these are contingent liabilities, so they don't pay at any cost. They only pay if the state is well managed or its finances is well managed or it's generating good revenue. And three, it only should go to those depositors who are the responsibility of the state, i.e. they are Lebanese citizens who had their life savings and lost them, or who basically were not necessarily speculating, but were there just because they needed banks to put their money in the bank. Very complicated, I agree. So I'm sure people will question that, but I'm just trying to state some principles that I believe will improve the situation on depositors in the bad bank, will give additional compensation to reduce the losses as much as possible. I tried to summarize in whatever 20 minutes what, again, I think it's a very complicated, not complicated solution, but a methodology for a very complicated crisis. So the devil is in the detail, I repeat, but I think this methodology, if we had applied it from the beginning, would have saved us a lot of time, and obviously it would have reduced the loss. And by now we would have had at least a banking sector or part of a banking sector functioning well. We would have banks, the good bank portion of the banks, running properly with bank employees focusing on financing and funding the economy, which is their mission, and not on basically managing disgruntled depositors and charging them excessive fees because there's no other business they can do. And in the meantime, we would have dealt with the bad bank part or this portfolio of fixed income, putting the depositors then directly in facing the state. That would be much more pressure. You can imagine an election year if those depositors were all basically owner of a management company that owns this big portfolio of state and BDL debt. You can imagine the pressure on the state to reform and to improve finances in order to repay those creditors. While by having the banks in the middle, it's actually really diluting the process, and literally we're going nowhere because you have a lot of conflict of interest, as you know, between what the banks or the bank owners want and between what the banking sector needs and what depositor needs. And I always make this differentiation. I have nothing against any bank owner. They took risk at a certain point in time. They built institutions, but ultimately I think they mismanaged the banks or management. They mismanaged the banks, I described it. They took too much risk. They siphoned out a lot of profits in dividend distribution, and they need to live with the consequences, which is basically that when there are losses, it's the owner who takes the losses first, not the depositor, as we're seeing now in terms of a situation which is unprecedented and will be a huge taint on our banking sector for years to come, that in Lebanon, depositors lost most of the money before any equity investor in the bank acknowledged losses or basically took any loss. This is, I think, my conclusion. I'm happy to take questions. I think I told Jean that I have, unfortunately, this was set up for 4 p.m. to 6, then it was moved to 5, but I actually have something at 6. I'll stay on the call after 6 as much as I can, but I have to multitask, unfortunately, so I'm sorry about that, but I'm sure Jean can answer a lot of the questions. Thank you very much again.
Thank you so much, Adel. Thank you so much for doing this difficult exercise of summarizing such a methodology in a very short time. But I'm sure now we have a lot of questions, and those questions will eventually allow people to understand better and to really have a better view on how such a methodology can help us. I would like to remind everyone, for those who would like to speak, please just mention this on the chat or raise your hand and we'll give you the floor. I'll start first of all with the question of Eli Nasnas. I don't know if Eli would like to talk or I should just ask the question. So Adel, Eli Nasnas was asking you, why are you against using the state's assets, whereby we all know that the state defaulted and the politicians or the political class who was managing this country was one of the main responsible of this huge losses and this huge deficit that was absorbing all the funds that are coming in Lebanon. So why are you against using those assets?
So this is obviously the whatever, like the $30 billion question, because everybody says state assets are there and we can use them. And I have to be very frank, okay? I'm not against the principle of, first, the state is definitely responsible. Mismanaging of public finances for decades, okay? And ignoring all the indicators. And obviously with results. It's not like, this mismanagement led to a booming economy or a fantastic infrastructure. So there is no doubt that the state is responsible and needs to take responsibility. The issue is more complicated when it comes to state assets. So one, I actually don't think the value of the state assets today will be enough to compensate all the losses. So even if we were to use all state assets, I mean, again, we talk about land and we talk about basically all these, this real estate portfolio. These are not monetizable in the near term. It's not like, we're gonna have people coming and buying them, or we can put a good value on them, or they're actually liquid in any way. So, but even if we were, I don't think the total value will be enough to do that. So that's a first point I want to make. There's not enough. But let's assume, again, we use all state assets to pay for the debt. From a pure financial principle perspective, when this debt was taken, okay, when banks and investors in the debt were earning 10 and 15%, okay? And this is a single B minus credit, okay? Or earning from financial engineering transaction in dollar, exorbitant rates, okay? It's very unfair or actually irrational to claim that they expected the risk to be low, okay? We all know basic rule of finance, high risk, high return, or high return means high risk. So everybody knew this was a risky investment because the interest rates was very high. And if at the time they said, okay, I'm lending to the state, but I want the government, I want the guarantee by state assets. I want the state to pledge the assets, and I want those assets to be used in case of a default. There is something in finance called basically secured lending or guaranteed or collateralized lending. And in that case, they should have earned much lower interest rate. So you cannot have both the cake and eat it. You cannot earn high interest rates initially, and then when there is a default, say, hey, I want the guarantee from all the state's assets because I want to claim those because I'm very surprised that I'm losing money on that high return, high risk investment. So that's the second point. There is no, you cannot transform unsecured debt into debt secured by state assets post default. And pre-default, you earn high interest rates because it's unsecured debt. It's not logical, okay? It's not near fair. So that's from a pure financial perspective. The third point, which actually is much more dangerous, you know, state assets can not only be used to pay banks or depositors. You know, we have at least 15 billion of Eurobonds holders who are international investors at this stage. They hold Eurobonds. So if we want to use state assets to pay back Lebanese banks and Lebanese depositors, the third point I'm making is there is a big risk that the Eurobond holders will say, hold on, I'm actually more senior. I lent directly to the government. Give me that money. I want the state assets for me before you pay banks or you pay BDL debt holders with those assets. And even more, actually, this can be trigger a risk where the Eurobond holders will say, okay, if you're mixing BDL and the state and they're the same entity, I'm going to go and ask for the gold, or I'm going to go and ask for the planes of Middle East Airlines. So this concept of using state assets from a legal perspective, that's my third point, is not that simple and could be extremely dangerous because those state assets could be claimed then by Eurobond holders before they can get to Lebanese depositors or Lebanese banks. There's no reason why Eurobond holders will be prevented from claiming the same because they're actually technically more senior than depositors or than the banks in this structure. So 3 points, as I said, the state assets are not valuable enough to cover the losses. Even if they were, financially, it's unfair to transform unsecured debt into secured debt post-default. And then legally, this can trigger, open a Pandora's box in terms of legal risk. And I'm sure people know that, where you end up with Eurobond holders and foreign investors claiming state assets the same way banks or depositors are claiming those. Finally, from a social perspective, I think we have to acknowledge that state assets are there to be managed better. Obviously, they're very badly managed. So yes, we want to put them in a company. We want to manage them better. We want to generate as much revenue as possible from those state assets. We want to be able to privatize some of them and generate revenue, yes. But the income or the revenue generated from all this is actually belongs to every citizen, and not only that percentage of citizen, which is banks or debt holders of the state. It's not fair to take all the state assets and dedicate them to one purpose only, which is repaying debt, repaying the dues of the state to debt holders or to the banks, while the revenue should be used to build hospital, infrastructure, schools, social protection. I mean, there's plenty of uses of state assets if they're well managed over and above debt holders. Now, if those state assets have been pledged, if we did a securitization trade at the time and said, okay, state assets A, B, and C are pledged to debt holders, and I'll use them as a guarantee, and I'll give them to the debt holder if I default, then yes. But then debt holders would not have earned the type of high interest rate because they would have had a much safer investment. I hope this answers this. In my opinion, those 4 points are very important to address. Having said that, final point, yes, the state is responsible. Yes, in every country where the state defaults, there is a haircut. Every country does a haircut. It's not unheard of. It's actually usual. It reflects the risk. We all know that there's always a risk of haircut on debt. That's why it pays high interest, and that's why there's a B- rating. And so yes, the state is responsible, but there is a haircut. Okay, the concept of haircut on sovereign debt is known. There's no concept that the state should pay every single penny of its debt. That's not the case in any other emerging market, in any market crisis, actually. There's always a haircut. That's the risk of this kind of exercise.
Thank you, Adel. Now we have two questions from two bankers. First of all, we have Nassib Robril and then Fadi Assayran. Nassib Robril, I'm happy to give you the floor if you wish to talk or ask a question, knowing that I started my career with my very first internship at Nassib. So go ahead, Nassib, please, and then it will be Fadi Assayran's turn.
Thank you, Jean. Thank you for your effort and for the Konrad Adenauer Stiftung roundtable and the invitation from RDCL. Unfortunately, I don't agree with most what Adel said. To begin with, this is a myth that the banking sector did not lend to the private sector and went all to the sovereign. This is a total myth. The banking sector lent $60 billion, which is in excess of the size of the economy, to the private sector, to all the private sector. And the proportions were similar to any emerging market, 1/3 consumer lending and the rest to all the sectors of the economy. If the banking sector has been successful enough to attract enough liquidity, the basic methodology of any rating agency a model of a bank is to place this liquidity in the safest assets, which is sovereign assets. And the central bank has put strict limits on how much commercial banks can place outside of Lebanon. Second, I love the idea that depositors should face the state directly because people tend to ignore this. There was a deliberate political decision to have a campaign against the bank, to put the entire responsibility of the crisis on banks. If there is the way to have depositors face directly the state, we would have avoided plenty of problems for the economy, for depositors, and for the banking sector. Third, what negates, in my opinion, this entire theory of a bad bank is the fact that the IMF, which, by the way, just announced that it has reached a staff-level agreement with Lebanese authorities, refuses to hear about these things. It has decided that the $72 billion in the funding gap of the central bank are losses and have to be borne by depositors and by commercial banks with zero responsibility for the state, essentially. It doesn't even want to hear about an asset management company, even the small assets that the government intended to include in this asset management company. And if you want to consider a bad bank in Lebanon, if we want to believe that those $72 billion are already registered losses, then the central bank has become the bad bank in Lebanon, according to this methodology. $72 billion in losses are coming from the central bank because the Eurobonds are already in default. The other point is regarding the losses of shareholders, that it's not fair that depositors bear losses before shareholders. This is another myth. The shareholders are the first and biggest losers in this. I'm not saying that depositors have been fairly treated or have not lost part of their deposits, but shareholders have lost 90% of the value of the Eurobonds that the banks have lost. They have lost the banks, the losses for the
banks. Hi guys, I'm still on mute for a bit. I'll join shortly.
The bank's revenues are basically going to cover provisions on Eurobonds and on private sector loans. So these are all losses on shareholders to begin with. So both shareholders and depositors are losing by this total neglect of the state to assume its responsibilities. Usually when you have bad banks in other sectors, in other countries where there are crises, usually they are for private sector loans, and they get part in an asset management companies, like, for example, in Nigeria. But this is very different. And again, if the IMF did not consider the $72 billion as total losses, then we might have, considered this idea of a bad bank. But because the IMF refuses to even listen to anything else, I don't know how useful this idea is. Thank you.
Thank you, Nassib. I will, Adil, before answering Nassib, I would like to give the floor as well to Fadi, so you can answer both of them, since you'll have to leave us. So,
Sure. Yeah,
Fadi,
absolutely.
Fadi, please go ahead.
Hi. Yes. Hello, all of you. Look, I followed Adil's opinion from the beginning, and I thought it was a good idea. Still, the only difference here is that Lebanon is a little bit different from all the other countries that you mentioned, Adil, because it is not few banks, even suppose the largest bank, okay, whether in the States or in Greece or whatever. It's the whole banking sector that has been wiped out, the whole banking sector. And the major reason, okay, you mentioned the fact that, the excess we have invested in Eurobonds or deposit and all this. But exactly the problem is that the size of the economy, in fact, Nassib has been correctly saying, the size of the economy, we have deposit 3 times GDP. And it's an abnormal. Usually countries, when we say we have 3 times GDP, the Switzerland example, the most of the deposits are offshore. Are offshore. They are fiduciary. They are not part of the system. The major problem, okay, there are several problems. It's one of the major problems that we let deposits come in the system, okay, and be used internally. That's the wrong thing. And that's a central bank policy that has allowed banks to accept deposits and lend them and use them domestically. So basically, when you lend deposits 100% of your GDP, the remaining, the only way to do it is to go to the theoretically best alternative is the sovereign. In any case, that's beside the point. My point is, if you have to look at bad banks, good bank, which is excellent idea, in fact, as methodology, and has been used. The problem is, if I have to assume that we are able to do that, so it means just assume that there is one bank where you put all the loans, which is commercial, one bank loans, and you have 16 billion deposits today out of the 104 that are the good deposits. Whatever the allocation, you do it, and you said it is difficult to allow whether small deposits or deposits for the institutions. There are companies that have deposits in any case. So you make an allocation based on the needs of it. The point is, now those deposits and those loans should be fresh, remember, which means now what you're saying, that the loans that we have lent, now they have to be repaid in fresh dollars. The last 2 years, we have reduced deposits by, $30-40 billion in local dollars. Now, how you treat that? So you're saying now the one that remained, they have not paid their deposits, have to be paid in fresh, and the other one has paid in local. You see, the major problem with this is that we have a currency, supposedly a dollar, which is, when we call it dollar or whatever it is, that's the truth. So we have a currency that is not correctly a dollar. So we have to admit that. Once we admit this, okay, whatever you do, then you can do a bad bank, a good bank, and face it. But you have to make sure that we are really saving the liabilities that are in local dollars for the banks. To be able to start again, we have to have fresh dollars, the transferable dollars. And to be able to do that, we have to solve the problem of the dollars in the banks. I don't think the only way to do it is through bad banks and good banks. Even if this is the case, you have to solve the problem of the dollars in the system, then to be able to do it in any case you want. Thank you.
Thank you so much, Fadi. Adel, The floor is yours. So you can answer Nassib and Fadi, and with your concluding remarks.
Yes, thank you very much to Fadi
and
Nassib for the comments. I would say a couple, I mean, obviously this is a very long discussion, but I don't want to get into the debate, but I would say a few things. One, yes, you're right, Fadi. It's complicated. Yes, we have a dollar and dollar issue. All this is valid. These are problems we have, whether we do a good bank, bad bank, or any other solution for the banking sector. Any restructure will have to deal with this. I want to stress, so I'm not saying the good bank, bad bank solution will solve the dollar structure, the crisis, or will solve the loan problem. All I'm trying to say is, if we split the problem in two, one of them, if we split the problem in two, we will simplify the approach, and we may be able, I think, we will be able to solve the commercial portfolio side much faster and easier than the bad bank side or that portfolio of troubled assets with the central bank and the sovereign. Whatever we do in any other solution, we can do it in the good bank, bad bank. The only difference that the good bank, bad bank is splitting the problem in two because they're very different, and because if we solve the commercial banking side of the equation, I think we'll have a banking sector that can go back to work while waiting to resolve that 70 billion hole that Nassib referred to. And yes, there is a big problem with that. But if we put it separately in a private company and try to deal with that directly, and if the depositors are the owners, trust me, I think that could probably speed the process and put more pressure, especially if we keep those depositors, only those who are clean money and basically depositors who have been screened because they deserve to have the state take charge or take responsibility vis-a-vis them. Again, I'm not saying it's simple. I know it's very complicated, but I think no matter what, this methodology will simplify any other possible solution. Now, I don't want to get into a debate whose fault it is and who's losing more money and shareholders as losses. I know shareholders are losing a lot of money now. I just want to stress one thing. Yes, you both said it. Deposits were too big for the banks to be able to just finance the economy. But that's the biggest problem. Why were banks attracting so many deposits to put those deposits in central bank and Eurobonds if the economy has a limited capacity by definition? Why was there this race for deposits at any cost to go and make those high spreads from central bank and Eurobonds and debt returns? The government said that. I mean, let's not be naive here or forget. The race for deposits was at the heart. Even though the economy was small, there was a race for deposits. Big is not better, but the banking sector in Lebanon thought the bigger we are, the better we are, even if all this excess deposits we're attracting are being put in risky investments. I mean, we're not going to fool ourselves by saying that this was forced. The deposits were not forced. There was a race for deposits. And yes, you can do a race for deposit if you want to, but put it, as Fadi mentioned, off balance sheet, like in other countries. Put it in a fund, put it in fiduciary, where the depositors himself take the risk if he wants to. But to mix it with the depositor of the old lady and the pensioner and go and risk all that, up to 60% or 70% in some cases of the deposits deployed in state debt, I don't think that's a valid excuse for banks to justify what happened. Finally, again, I know shareholders are losing now. Yes, I mean, they're losing because the banks are technically bankrupt, that's admitted. But the amount of dividends that have been paid in the last only 7 or 8 years is huge. I actually don't have the numbers, but I don't know how much paid up equity shareholders have put and how much multiples of that they have earned in dividends over the years. So let's again be scientific here, and I don't want to get into the debate. I feel for everyone. I have friends in every category of stakeholders, but we have to be fair. Ultimately, a lot of dividends. I mean, if in 2019 alone, 18 alone, in a country which is in recession, okay, which is at the verge of collapse, $1 billion+ of dividends plus preferred has been distributed to shareholders out of 2 billion of profits. That's 50% distribution in a country which is B- and on the verge of collapse. So I don't think all these are basically practices that are prudential, that are cautious, and that basically we can just like ignore. But ultimately, it doesn't matter who's losing more. We all know if we are a true capitalistic system, equity is the first to go, not debt, not depositors. There is a simple and straightforward waterfall that we have to acknowledge. It's not my invention, it's no one's invention. This is how it works. And I think this is at the heart of how a system operates in the capitalist system.
Adel, thank you so much. We won't hold you longer.
Yeah, I'm very sorry because I'm on this other call and I'm delayed as well, and I really apologize.
Don't
I'm
worry
gonna keep
at
you
all.
here. You can wave to me if there's an urgent question, and I'm following the chat, but I have to move to the
No, we're
other
going,
call.
anyway, we're going to conclude. I would really like to thank you. Thank you for your time.
Thank you very much for everyone who listened in. And again, good luck to everyone. I know it's very complicated. I can't claim that any one of us has a magic solution.
But at least there are solutions. This is what's important. We should know that there are solutions. There is a lot of way of managing this crisis. The biggest crime is not doing anything. The biggest crime is letting or kicking the can down the road. We are kicking the can down the road until we have kicked the country down the hole, and we have to stop this. Solutions exist. We need to have people that has the will to implement, to work, and to think about the country, of the well-being of the country, of its citizens. So thank you, Adel. Thank you, everyone. I'm going to give the floor now to Michael, who's going to give us his conclusion.
Jean, thank you very much. Adel, thank you very much. I do not have much to add, I have to say, to what you just said, Jean, as a conclusion, and also to your analysis, Adel. I think we've come to a point where there are no easy options left, actually, right? So the World Bank, according to the World Bank, the country here is in one of the worst recessions of the past 150 years. That means the need for reforms is tremendous, and what is clear, you have to start somewhere. So that's why I'm very grateful that Jean and Adel put a very concrete proposal here on the table that was discussed here, and I think we all agree it's that the model of a bad bank is not. Is the last resort. If you've reached a point where there seems to be no other way out of the financial crisis and the crisis of the financial sector, then such a model indeed should be considered and discussed, knowing that, of course, there are a lot of questions, and I think this was also clearly highlighted by Adel, that need to be addressed. But well, this is where we've come. So we've come that far, and we need to tackle these questions now. And so I'm very grateful for the proposals, and I hope that they will be discussed further by the policymakers here and also internationally. Thank you.